Okay, welcome back. This is going to be trade plan. This is SB Trades, steel basis on Twitter, and this is the trade plan. And we're doing a video version. So this is a trade plan for January 4th. So we put one out last night, January 3rd for today, and this is the second installment. So like I said yesterday, I want to do these videos just to get myself, I guess, better with communication and public speaking and that kind of stuff. I'm not really used to doing this kind of stuff. It's not I guess it's not a skill of mine, but I'd like to try and get better and try to communicate in various ways. Especially in trading, you can find yourself kind of getting stuck in the weeds, stuck in your head, stuck in data, stuck in spreadsheets or code. I think this is going to help me to get myself out of that sometimes and get myself more into that mode of being able to communicate ideas and thoughts, and that's scalable in life. So without further ado, let's just talk about today. So first thing we do is the postmortem. So what basically our call for today was to be long, and the market. I don't know if you guys saw last night, the market opened up and it just spiked. I think we rallied all the way up to like 39.05, I think was the high last night. So, that was a gap, right? So a lot of these gaps tend to fill, and this one filled really fast because by a couple hours later, we were trading like around unchanged. Around that price, I actually put on my position because I didn't have my complete position on from last Friday's close because we had the market closing for New Year's holiday. But I was able to put my position on. I actually got a little bit of edge, and we talked about that. Sometimes the market gives you edge. I wasn't going for edge necessarily because I know my price. I know what price I want. I want settlement price. The model is based off of daily returns, so settle to settle. So for me, I want to get at least settle. If I could do a little bit better, then I'll do it. And I think a lot of that's up to just execution savvy. How often are you? And when you watch markets every day and then day in and day out, you're gonna gain some kind of intangible knowledge on how these things move at certain times of the day. Or you might say, you know what? I think this is gonna probably come off or pull back to a certain level, because for whatever reason that level has some importance, and that happens. And I think that just comes with skill and with time, and you build that skill with time. So we had I think overnight the market rallied once again. At that time I did take some off, so that 3,900 level was has proven to be some resistance for a while now. So if you take a look at a chart of the S&P, if you look at the ES future, you'll see that since like December, I don't know, like 16th, maybe 17th, the S&P has been very range bound. So it's just kind of like oscillating back and forth between about 3920 on the upside and 3,800 on the downside. So that's been the range for the past 2 weeks. Contrary to what people say about the bearish sentiment, they're not exactly being proven right just yet. And same thing with the people who have a bullish sentiment, the ones who come out on days of big rallies and say, well, that's it. Markets put in a bottom, blah, blah, blah. That type of talk is nonsense, in my opinion. What you really have to focus on as a trader, especially, is what's going to make you money. Where is their value? What price is their value in, whether from the short side or the long side? And then you can get in at that price and be able to make money, from whatever move arises. A lot of times you can't really predict necessarily how big the move is going to be. Well, I shouldn't say that. You actually can predict the size of a move, the magnitude of a move, more than you can predict the direction. Direction's super difficult to predict. Like when I started building models, my goal wasn't necessarily to define or to be able to predict direction, but my goal was more to be able to predict range, volatility, and from volatility to understand what creates range expansion and what creates range contraction. Within that realm, you can identify points where you are more likely to get bullish action at a certain level of contraction or expansion and volatility, or more likely to get sell-offs. So by looking at the characteristics of volatility, you can have a better sense of what direction might be coming in the near future. I think a lot of people talk about this kind of stuff, especially people who are volatility traders. So that's kind of the direction that I take with my model building. Anyway, the market today ended up again just kind of bounced around quite a bit, ended up down a little bit. So our call was not exactly correct, but because of how much opportunity we had to exit or how much the market rallied throughout the day. It was kind of to me, it's kind of like not wrong, not right. We had both. You could have been bullish today and you would have been right, and you could have been bearish and you would have also been right. And also look at the Dow. The Dow, basically unchanged, and the Dow's kind of been a beast, and we'll see if that kind of persists going forward in 2023. So. What's going to happen? What's our viewpoint for tomorrow? So actually, we're maintaining the long position. And one of the things I'll say is that, and I said this yesterday, is that the first week of the year tends to be an extension of the holiday trading environment. So we're seeing not great liquidity, so that's why you're kind of seeing these markets gyrate in kind of larger ranges. But by the end of the day, those ranges contract, so the settle to settle moves are not very big at all. So that might continue for the remainder of this week, and then once we get that first catalyst, which will be the jobs number, that might be the point where things start to change, and that's kind of lining up with some of the indicators that I'm looking at. So this LI indicator is still active, so this is kind of our watch out below. Where that price where LI is activated is this magnet price that I call it. It's not, we hear this term used on Twitter a lot, but for me it's a magnetic price, 38.22, because that's from that price I don't expect much deviation. And if we were to get upside deviation from that price, so if the S&P were to close at say 3,900, I would be aggressively short because of this LI indicator. And as long as this LI indicator is active, and it is going to be active for at least for the next couple of days, the value sits at negative 5.5. As long as this value is below 1, the indicator is active. So if we do get a big rally, if we get that move, and I would be delighted if we got that move, that would be the place for me for where I would be piling in short. So once we get some sort of kind of dislocation in the market, and we get that from 38.22, I think that's the point where you're going to get short. I'm not going to buy big dislocations from 38.22, but I am going to sell them, and I'll keep you guys posted on because once this LI is not active anymore, then 38.22 disappears as a significant price. Okay, so what do we see for tomorrow? So for tomorrow, the reason why we're staying long is because of a couple things. So we have these not indicators, but factors. I call them IJ and IM. So IJ and IM are factors that relate to the yield curve. So they're derived from the yield curve. So all these factors I talk about are synthetic factors. They're proprietary, so I'm not going to discuss how we build them. But basically, IJ and IM are yield curve metrics. So they're kind of looking at the yield curve and saying, okay, what's the likelihood of stocks or risk assets repricing because of yields, because of some dramatic repricing in yields. And so, it's kind of like trying to predict an earthquake by looking at tremors or looking at deep crust, motions or something like that. I'm not a physicist or a geologist, but it's kind of like looking for these clues. And because from my point of view, the rates environment dictates how risk assets are priced. So IJ and IM are very contained. So they're almost an II, and then on top of that, we have this II indicator, which is it's an oscillator. It's sitting at a very negative extreme. So this has been the case now for like I want to say at least 5 or 6 days, which is really odd. And I think it has something to do with the fact that we're in this holiday trading environment. But in that scenario, whenever we have a CQ, so CQ is just the daily return. So today we had a daily return less than 0. So whenever that's the case, and this other indicator, this other factor BP is 1, and CI is not overextended, so we're not at an overbought region, we tend to get upside returns. Okay, so what that's to put it more clearly, we tend to get mean reversion. So today we had a down day. We should expect tomorrow to be an up day based on based on this scenario described by this set of factors. So this IM scenario, it can also dictate a short position, but the only time it dictates a short position is if we have short-term overbought scenario. So whenever we have this CM factor, which is just a relative price factor, if that's greater than 1, or the previous day's return is greater than 0, then we're more likely to see reversion. So the price coming back down. And in those instances, did I say that right? We go short in those instances. Yeah. So so that's not what we have today. We don't have that set of factors that dictate a short position. We have the long position, so the number 2 and not number 3 on the trade plan. So the bullishness, I'm going to temper the bullishness. So because if we just look at that set of factors together, the upside returns are like in excess of 1%. But I don't think that's what we're going to get. The reason why is because of this GU factor I've been talking about. So GU is 1, and that normally dictates a flat position. That tells us to stay flat. The reason why it tells us to stay flat is because there's not much, we don't expect much to be in the market. We don't expect settle to really change much. So we don't want to take the risk or take the holding the position throughout the day, because intraday the market could go up and down 1%, right? And then at the end of the day it's unchanged. Well, that can happen when GU is 1. So the reason why we would typically want to be flat when GU is 1 is because we don't want to hold a position while the market rallies 1%, comes back off 1%, right? And then just to be flat at the end of the day. That's a bad use of margin. So whenever GU is 1, essentially we have to temper all these our bullishness and our bearishness. We have to say, okay, GU is 1, which means that the actual daily return, if we're thinking it's going to be about 1%, it's probably going to be a lot less than that. Doesn't mean we don't want to take the long or we don't want to take the position. Just means that we shouldn't expect that much out of the position. Okay, so that's kind of, GU is still 1. It's been 1 for like 4 or 5 days. That's why we're seeing range bound, right? So this is consistent with what we're seeing in the market. Despite the intraday volatility, settle to settle returns are essentially 0 for the past, while, like over a week, close to 2 weeks now. So I think this is significant. And I think what's gonna happen is that we're gonna break out of this range, and I'm waiting for this GU to turn off. So once it goes from 1 to something else, doesn't not necessarily turn off, but once it goes from 1 to another value, which once we get that value, I can just look up what that value means and let you guys know. But that's when I'll know, okay, the market is now unhinged, right? So we're gonna get either an upside move or a downside move. So we're not there yet. Okay, so that's one scenario that leads me to be long. The other scenario is what we've been talking about, and actually I made a mistake in discussing this AD factor. So AD factor is persisting at -1. So it was -1 yesterday, it's -1 today, and I think it was -1 the day before that as well. So actually -1 is not bearish the dollar, it's actually bearish the euro. So why the euro? Well, because the euro is the biggest currency in the dollar index basket. So that was a mistake that I made yesterday. So this -1 value for the euro factor, that actually coincided. That was accurate because we saw a big down move in the euro today. Finally, right? The euro has been on a tear for that at the end of the year. In December, it was like up a lot. So when we see this euro factor at -1 and we have our commodity factor at 1, which that was not accurate today. Well, I mean, I shouldn't say it wasn't accurate. We saw a big down move in crude, but we had big up moves in some of the metals like gold. So there's some within the basket. There's some conflict, but the commodity basket overall is still signaling a 1, which means that we're bullish. The model is bullish. The factor is bullish commodity. So whenever we have a bullish commodity factor combined with a bearish euro factor, and we combine that with our AH indicator from SPY model, and then we combine that with the lag of CQ, which is just the previous day's return of the market. When that's less than 0, again, we see a mean reversion. So if we had a down day today, we would expect an up day tomorrow. Okay, and actually in this scenario, expected return is 0.9% with a positive hit rate of 71.5%, and the max tail is about down 1%. So that's from the in sample distribution. So we'll see. I'm not hot about this tail risk, like the down 1%. I like the hit rate at 71.5%. You can't really get much better than that. Expected return 0.9%, but that's not taking into the consideration that GU is 1, so I would expect that value to come down quite a bit. With the expected return coming down, I also expect the distribution's standard deviation to come in, so we'll see that the Sharpe should stay relatively unchanged that we're working with for tomorrow. So we'll see. I mean, I think this is on the margin. This is bullish to me. Okay. Now risks. So risks to the long outlook. Okay. Well, one of the risks that I see is that we had this AH factor yesterday that was set to -200. Well, that flipped to 0 today. And whenever the lag, so whenever we go from -200 to 0, so that delta so the 1 day lag of AH is -200 and the current day is 0. Whenever that happens, that transition has a negative effect on risk prices. So we tend to see negative returns. With that being said, that's just looking at AH in isolation, and AH is actually a pretty complicated factor, so sometimes I do look at it in isolation. But in this case, when I combine AH with the fact that the euro factor is -1 and the commodity factor is 1, that brings the risk in significantly. So we don't see the same tail risk on the downside anymore, and we still have expected return at a significant positive level. So that kind of alleviates my concern with the potential tail risk. So we'll see. I mean, again, that to me is bullish. And actually, I'm looking at the market right now. The market's up right now. I think Nasdaq's going, rallying a little bit. So this is so far, things are good. So now we can talk about the CM indicator from SPY. That continues to be in a stopped out state, stopped out and flipped. So the long was stopped out, and then it flipped to short. So that flip to short is still active, and the reset. So this factor is going to reset soon, but I watched this really closely because for a little while there, it looked like we were going to get that bump above zero. So CM is an oscillator. It looked like we were going to get that bump above zero from below to above zero. So that would reset the indicator. That didn't happen today. I thought it was going to happen today. It did not happen today. And actually, we kind of drifted back below a little bit further away from zero. So that tells me that gives me a little concern because that keeps CM in a short state, and that stopped out and flipped state. So, we'll see. This is not going to make me forget, stay away from the long position because this could easily come back tomorrow. We could get some inflow tomorrow into the market, some buyers in the market, and that could push CM into reset. But that's a little bit concerning. I'm really anxiously waiting for this to reset because that's going to give me a new medium-term outlook. I don't know if I've talked about CM before, but this is a learning indicator. So, and I'm kind of really excited about this one because basically it learns. It's a medium-term indicator, so it's not daily. So we'll hold a position for multiple days, sometimes even multiple weeks, and it will stop itself out if it thinks it's wrong, and it will actually flip the position. And so every time it puts on the position, it's using a machine learning algorithm to say, okay, based on what I've seen and based on what I can extrapolate from that, does this position offer me edge? Meaning, is there value in this price that I'm about to execute? So, again, I'm waiting for this thing to reset because then I'll get the new signal, and then as soon as I get that, I'll publish that out to you guys. AH from SPY is back to incrementing itself after stalling for 12 days. Yeah, this is bullish. So we're waiting on this to continue to increment today. So that's saying that it likes the price. It's kind of like you like this yesterday, you like it more today. So sometimes you should feel that way. Sometimes if you like something today and it goes down the price, you should like it more. That is true. Sometimes you should feel that way. Sometimes you shouldn't. And that's kind of what this indicator is saying. So when this indicator wasn't incrementing for 12 days, so it was kind of stalled out, it was like, whoa, I don't know if I like this anymore. So we don't trade this, but this is definitely an input into the model. And it's a valuable input. All right, so I liked it yesterday. I liked the long yesterday. I like it more today because of the fact that this thing is still incrementing. So that's good news for the long position. So we also have a new indicator. So this is AH, again, AHSPY. It's called AH over the hump. So this kind of builds on the same concept of this AH factor, which is incrementing, saying I like, and then sometimes it'll stop. So flatten out, just kind of say, okay, I'm just going to hold what I have and not add, and I want to reassess, and I'm going to keep reassessing. Every day I'll reassess, and then eventually it says, okay, I'm over the hump. I feel like I know what I'm seeing. This makes sense to me, and what I'm seeing is value. Let me start buying again. So this over the hump indicator builds on that concept, and this is new. So this factor is new. It hasn't been built into the model yet, but I'm testing it as a standalone item, and it's working great so far. It turned to its max bullish state today, and the reason why it did that is because what this factor does is tries to measure the aggressiveness of sellers or buyers. So how aggressive are people in the market? Are they price takers? Are people who are in the market right now, are they going in and hitting bids or lifting offers, meaning they aggressively want to put on or take off a position? Okay, so right now that measurement is basically at its flattest level that it can possibly be. And on top of that, the delta of that metric day over day, so the change from yesterday, went flat today as well. So basically that tells me that the market is kind of no longer in this state it's no longer in this place where these price takers are going to have an impact on liquidity. Okay, because when people keep hitting bids or lifting offers, market makers say, "Whoa, I gotta make my markets wider. I gotta do something to manage my risk more because I'm collecting inventory, whether long side or short side, and I'm having to hedge, and hedging can be expensive, and so that's not good that's typically bearish. But when we see this aggressiveness kind of subside, that's when markets can just kind of levitate, right? That's when they can just kind of pursue their natural drift, which is to the upside. As much as people want to say that's not, it is. I mean, the natural rotation of the earth dictates that, that prices need to go up. So that's kind of like the default that I take, at least. That's my default stance, is that naturally prices go up, whether it's 2% or 4% or 10% or, fine. When we have deflation, that's a different story. But we don't have deflation yet. And for the moment, prices should go up in the default scenario. So that's the scenario that I feel like is in place right now. And by the way, this can change, right? So these are high frequency indicators. I mean, they not terribly high frequency. They're not minute by minute or hour by hour, but they're daily frequency indicators. So these can change. Tomorrow things can change and we can alter the stance. But for now, that's what we see for a one-day outlook. Okay, so I mean, this thing says, so based on that over the hump indicator, AH over the hump, I mean, it says that we could see a surprise upside tomorrow, like over 1%. Again, I'll temper that with the fact that GU is equal to 1. And when GU is equal to 1, we tend to see ranges, or settle to settle ranges, settle to settle volatility, contract. So if it tells me 1% and GU is 1, I'll probably say, okay, I'm going for maybe 0.5% at most. And if I get more than that, great, as long as I'm on the right side of the position. Okay, so that's about it. In summary, we're maintaining along. If you have, if you've been holding this, so here's a little side note. The longer you're in a position and you're not able to take that position off, the more aggressive you should be to take the position off. What does that mean? Okay, so if price is drifting against you, this is not happening right now. Right now we're getting big spikes up and down. We're kind of just like oscillating, and this is really good for trading. But if you ever get in a position where you're kind of like, I'm in this thing and it's not giving me a place to take it off, well, you should be more aggressive, right? You should work your trades like you're like someone who's got a trading business. They're collecting inventory which is their positions, right? And they want to churn these positions somehow. Maybe not every hour or every second, but they might want to churn them like every couple days. And if they're not able to do that, they should bring in their market. So if they're holding a lot of long stuff, they should bring their price down. At the price they're willing to sell, they should bring that price down. And if they're short about a bunch of stuff, they should bring the price that they're willing to buy higher, right? So this is just inventory management. Just because the market's not giving you an opportunity to take the position off or the place where you want to take it off doesn't mean that you shouldn't be looking to take it off, right? Because it's just a matter of managing your inventory of cash and inventory of risk assets. You need to manage that, and that's how you would do it if you're running a business. So have that in mind. So for now, I'm not concerned about holding a long for too long yet, because we have only been holding this long for a few days. But if the market was starting to feel like it's not going to bounce above, let's just throw out a random number, 3850. No, not 3850, like 3900, for example, because that's kind of been like resistance lately. 3920 has been kind of a resistance point. The closer we get to 3920, right, the more I'm going to be willing to sell. Like the more aggressive I'll be of a seller I'll be, especially because I've got this thing in the back of my head, this LI indicator, which is telling me that as long as this thing is active, I should be I should be selling the big rallies, not buying into them and not holding along after a big rally, right? So that's kind of important for now. So, the market's rallying right now. We might get a rally tomorrow. So if we get a rally tomorrow and it overextends, let's say it goes up 1% or 1.5%, you need to be selling that into that, because we're not positioned for a long-term rally just yet, okay? Especially because we're only in the beginning of the year at this point, and we haven't had any catalysts that will push us one way or the other. Okay, guys, I hope this didn't go too long. This, I guess, 30 minutes. I guess I went a little bit shorter than yesterday's, but I appreciate your time. If there's any complaints or anything I can offer up that is missing from this, or that you want to hear more about, or my opinion on something else that I'm not talking about right now, just reach out. Right, reach out to me on Twitter or the Patreon, or wherever. Or I think my email is also on the trade plan. Just reach out, and if there's anything, and I'll do my best. I can't promise anything, but I'll do my best to offer up what I know. All right, guys, appreciate it. Have a nice night, and good luck trading tomorrow.